Today Bala joins us. Let's take a conversation forward. Good morning. Thank you for joining us. It's been a good market, locally and globally. Gold, silver, Bitcoin, NAV mutual funds. Everything is at an all-time high.
That's right.
Where do we go from here?
I think it should remain positive for multiple reasons.
When were you bearish last, actually?
I never been bearish. If I had been bearish, never would have made the investment in the market.
Okay. So you're bullish now. What should one do?
So I think the way things are shaping up, one with respect to the international development, right from geopolitical risk to the tariff, we are now seeing some kind of direction coming in, which I think will be more positive rather than being negative. That's one. Second is look at within India, the growth is gradually is coming back, supported by the government increased government spending. There has been increased spending coming from the private sectors. And third is the Reserve Bank of India has been fully supportive of keeping the interest rate low, and they are doing everything that is possible for the financial service sectors actually to improve the overall credit offtake in the marketplace as we move forward. If you look at the whole environment, is actually supporting the growth to come back, and the inflation largely is under control. So that has been the case. Broadly, the earnings of the as the spending starts coming in, I think we probably see the numbers for companies getting better. Therefore, the earnings outlook will get better. So broadly, when I look at it on a cost of capital basis, I think, and today, with interest rate where they are, the cost of capital in India is actually the most affordable, and anybody can build a business with reasonably good predictions in terms of what the kind of margin they'll make in terms of ROE. So that is, I think, we are in a good sweet spot, and fiscal deficit large amount of control, which again give more rooms for government in case they want to spend more money in the hands of people, so that lift the whole economy. With the recent announcement coming from the government, creating an employment, first time employment, you give some kind of income in their hands, which again encourage people to seek for employment, and that's the way I think the whole momentum will get picked up. I think we are in the right direction, and markets have already got consolidated quite nicely for the last almost about 6 to 9 months. And we have weathered around all the volatility that hit the world quite successfully. And probably my own belief is India is getting a little more stronger in the whole, so to speak. Only the risk with, of course, which anyway always there, that China is also in another economy which is coming back quite nicely, and therefore will always be question mark in terms of how the flows will come from overseas market to the emerging market, and within that how much share will come into India. These debates and question mark will always remain, but otherwise the domestic economy driven by the domestic consumption should be the major driver.
But Bala, how many of these positives are already in the price? The fact that we are just 2 to 3% away or at an index level from the all-time peak, do you not think that this is already all baked in by the markets?
See, this positivity of course continues. I think that reflects on the way the inflows in the mutual fund, the overall participation in the equity market reflects that given the past trends that we have seen, despite all the uncertainty that came in, India actually behaved quite nicely from the overall market perspectives. So that is being the case, I would say it's already priced in, and to some extent it's getting discounted. But where is still no clarity which has come in terms of how the earnings will pick up. Say today, at where it stands today, nobody wants to take a call in terms of to what extent earnings will start showing upward trend, and even analyst predictions are not being very clear. But I think as companies start delivering the next quarter, see today nobody is able to gauge what the real impact that will come on the interest cost saving, which has been one of the lowest in the country. In the rate of home loan rates, to what extent home loan rates will drop, therefore more demand will come. So these predictions are not being currently made. And even the auto sales, and there has been a bit of a sluggish period on auto sales. But I think we need to also take into account the agriculture, the monsoon has been so good, rural economy continues to do very well. And government is pushing quite a lot in terms of rural India focus, and therefore all those things will lift actually the income in the hands of people. As the credit starts picking up, it lift the money in the hands of people, therefore the spending will start coming back. See, this is a question of time, and nobody wants to, of course, at this point of time predict, given the fact India is still trading at say 20 time P multiples. So if somebody takes a leap of faith call and goes wrong, and nobody wants to go wrong. I think today's is not about you don't want to be bullish. Nobody wants to go wrong by making wrong predictions. So that's the way I will say people must be reserving their judgment, bullishness, and upping the earnings growth without confirmation coming from the companies themselves.
Sure.
Yeah.
But in your MF schemes, you're all in, or are you still sitting on some cash?
No, cash will be about 3 to 4%. I think if we are fully invested. In fact, as a fund house, I think been quite successful this year in terms of being bullish. I think I still remember my CIO equity just about 8 months, 6 months back. He said now time has come to dial the risk. So which is nothing but taking a bet, and we're putting a leap of faith back on table and taking a bet, and that's the way I think as a fund house we have done it.
All right, Bala, the select sectors that I see in your fact sheet where you have been taking the bets in terms of recent additions, one of the sectors is actually insurance. Help us understand that how do you see the insurance story in India shaping up, because this has been one of those sectors wherein the growth of opportunity or the market size has always remained that large, but the penetration numbers told you the other story. What is changing now within insurance?
Second, as the sector has gone through consolidation, and the last 2-3 years, if you look at it, the sectors have remained underperformer. At the same time, the focus that is coming in, as we have seen in the case of mutual fund business, and the insurance industry also underpenetrated, and the increased focus is coming in both from the government and the regulator that every citizen of the country should have one insurance policy, as we keep saying that har ghar mein ek SIP hona chahiye. That's what we keep saying in mutual fund side. And the same way, the insurance also now is actually getting their act together, and therefore try to drive the whole mind recall which has to come from buying a policy is also equally important as you make investment in SIP. So that, in my own belief, is will actually increase the penetrations, and deep commitment is coming, and then new product offering that is coming from insurance companies. Also, I think now increasing the size of the pie, the size rising. Therefore, having seen the consolidation, it's a more of a relative bet. I would say it's more of a relative, as we keep saying, from public sector banks to the private sector to public sector, from a large size NBFC to the mid size NBFCs. The same way, mutual funds, asset management companies, the listed space, and insurance companies also the more as an alternate is been coming in. It's a more of relative value bet.
So is it a life insurance, health insurance, or general insurance that you're betting on?
I think largely it is on the life insurance business. I think that's where the deeper penetration is still coming. And anyway, in the case of health insurance, limited number of players are there.
Everybody likes banks, and that's the problem. How will anybody make money when everybody likes it?
So I think this will be a sector which we cannot say dislike it.
Is it because of benchmarking? Because
one is the benchmarking. See, I think banking and financial sector is a proxy of the economy. See, if you want to measure the success of the economy, how the banking industry functions, actually will tell you how the economy is doing. So the banking and service industry, banking and financial service industry, it's a provider of raw material for everyone in the country. And second is they are the one driver of the growth, as we keep saying. As the credit offtake starts picking in, you'll probably see the equity market also reflecting in terms of either senses, not only because of the index weight of financial service industry is pretty large, is also because of the impact that creates on the entire ecosystems. So since they are a provider of raw material, provider of money, the cost of capital interest cost is coming down, therefore deposit cost coming down. And as they start increasing lending more, the ROE that's coming in is ROE is coming for the banking industry is pretty large.
So I'll throw two numbers at you. Credit offtake has come down from 13% to 9%. GST has dipped in single digit now. These are and auto sales, what we got from last 2 months, they are not great.
Correct.
If I add all these three data points, it clearly tells me that economy is slowing down. And this is the high frequency data. It is not IP data which comes on a quarterly basis or GDP data.
Effect.
Yeah. GST is in single digit. Credit growth is in single digit. And auto dispatch numbers are not picking up. So while it's good to be bullish, but the data points are telling me a different picture.
So I think while of course data points, which anyway data one cannot ignore, and that is a fact, what is coming is a fact. Is it a trend which is going to be everlasting, or is it a trend which is going to change? The step that is being taken to correct this trend is also equally important. I think if you take the example of when the Reserve Bank of India new governor, when he took charge, his single point focus for the governor, first time I saw telling him, is about growth should be his high priority. The moment growth is become a high priority, all the steps that is being taken, whether it is a cutting rates or advancing the rate cut well ahead of the market expectations, and then making the ease of doing business when it comes to the question of lending, provisioning, infrastructure financing. So I think the whole ecosystem that is now being built, it will support the growth. The way I see is the market always starts looking at, market doesn't look at the short term. Market always looks at 1 year down the line. As we are in 2025, I don't think any analyst will look at 2025 earnings to put his predictions. I think we'll start looking at 2026. I think since a lot of moving parts, while some of these macro variable numbers, what you say could be true, but if you look at the trend in general, in order to that to change, the step that is being taken to support the trend to come back, I think are a lot more positive. Therefore, the market will start looking at 26 earnings. Maybe one has to, of course, remember the fact that I think Indian markets has been trading at a high P multiples because of the high growth expectation that is coming in on India. Therefore, there is high probability that return expectations versus what actually comes in could be relatively lower. So that's something we have seen 16-17% kind of range or 20% kind of range if somebody expects, versus that we may end up getting about say 10-12% kind of return. But that's only where one has to keep the expectations somewhat moderate.
So Bala, where else? I mean, banks, like you said, is part of everyone's core portfolio. It's a have-not you cannot ignore. But where else do you find some opportunities, any new additions that you would recommend to one's portfolio? Or is it just more of the same that one needs to have?
So I think no need to look at anything new. As it is, if you look at from an investor's point of view, it's all well settled from point of view of making the selection relatively easy, which is from a fund house point of view, now we have, I think, established track record, the diversified equity funds which contribute about 65 to 70% of the overall portfolio, it does well. But having said that, in addition to sectors that are that are doing well, which I think potentially could be the value, the return generator. So one of course is the capital goods sectors. I have gone through its own consolidations. Now the spending aggression that is coming in would lead to an increased order book positions, and energy sectors will continue to remain a sector to watch out for. That's why the portfolio manager is taking a bet. And the non-banking financial services gone through their own piece of consolidation. Therefore, cost of borrowing coming down. Therefore, they may lift actually the ownership among portfolio managers. And pharma sector is relatively stable. If tariffs not going to get impact the pharma as a sectors, I think the sectors will remain forever. And likewise, there are multiple sectors of this kind will anyway form part of the overall. Like telecom industry is again doing extremely well. I think most of us are having a large ownership in telecom as a sectors, and the service sectors, even in IT sectors, have gone through its own phase of consolidation, and they are paid whatever had to pay in terms of market price reactions that already happened. So therefore, these are some of the things I think based on the value buy, depending upon how the balance sheet is getting now shaped up. So money managers will take that call. But from an investor's point of view, it's become relatively easy not to chase return, not to chase sectors, better to be in the diversified portfolio.
Wherever you are. But when you talk about capital goods and defense, for defense, of course, a large part of the rally is now behind us. Is it more a basket approach that one needs to have a little bit of all stocks, because these are very large sectors with very different and varied companies?
Correct.
Or is it time to be very specific and, select specific stocks?
See, there are certain sectors it is better to play through a basket approach. I think defense, you rightly put it, there are many companies that are trying their luck on the defense side.
Yeah.
Some of them established, some of them have got established track record, good order book positions, but executions will take another 3-4 years for it to reflect on the revenue as from the bottom line. But they have a huge capability. And there are large companies coming from public sectors. Liquidity may not be there for one to buy big time, but at the same time one has to have part of the portfolio. I think the best way to look at is I was looking at our own defense fund. I think we felt we are launching the fund at the wrong time. And everyone was criticizing us, saying the fund is being launched at the wrong time, it's not the right time to launch a defense fund, valuations are costly. In fact, to my surprise, the NAV of that fund is close to about 12.8. It's just about a 1-year-old fund. The reason is we didn't take any bets on single companies. We took a basket approach. In the basket approach, there are 3 stocks that are doing exceedingly well. There are 2-3 stocks are actually upcoming success stories, and there are not 2 stocks that have not gone anywhere at all. But the moment it has become basket approach and taking into account the size of those companies in their presence, and also the companies which are more like a startup companies are actually getting into the defense segment, they generally unlock value initially, then they go through a consolidation time for it to reflect on the earnings and so on and so forth. Therefore, basket approach, even on the public sector side, it's a basket approach is the one which normally I always suggest, because all public sector banks are more or less equal. So in what way one can say I am different from others. But in that such scenario, market always rewards some companies a little better than others. Therefore, the basket approach on certain areas is far better than taking a single stock kind of calls.
But why is that? I mean, let's look at the defense space. It starts with guns and machinery, goes all the way to drones. Not everything will do well. So basket approach, some would say I'm betting on the theme, but the idea of fund management is not to do basket. Idea of fund management is to buy active stocks which will make money.
Now, while your point is right, but each one of them actually within the defense sector is diversified. There is no single company you can say 100% defense focused. They have a diversified businesses. The private sector, if you take, their main core strength is come from automobiles. But defense has now become a larger component, increasing component of which is showing a greater growth and becoming one of the division of the existing companies. Then how do you play that? So you have to take actually the SOTP kind of model. And there are certain companies the 100% defense focused, but they also been companies not fully actually have own capability. They also have capabilities derived from the world joint venture partnership and so on and so forth. Therefore, that is being the case, basket approach is always better, and given the fact that they are all diversified companies in their own way, and single stock exposure when you take, that can be taken by a portfolio manager in a larger schemes where he will take only 1 or 2 stocks, given the fact that he operates in a model where he doesn't own more than say 55 to 60 companies in any portfolio. Such portfolio manager will take. But from a exclusive theme point of view, and the basket approach is the one which ensures that you own every stock that actually has a presence in the segment of the opportunity.
And if it was fine in defense if you did this in 2020 or 2021, not now for sure. Right. Bala, so great having you in the studios. Thank you as always for your time.
Thank you.